Welcome back to Squawk Box this morning. Alphabet, the parent search giant of Google, took a hit on revenue growth in its latest quarterly result. That's something you might not expect with most of the country glued to their phones at home. During Alphabet's earnings call, CEO Ruth Porat said, quote, "The decline in our search and other ads revenue was abrupt in March. And although we're seeing some early signs at this point that users are returning to more commercial behavior, it's not clear how durable or monetizable that will be." Joining us now with a lot more on Alphabet and how online advertising is holding up and what the world of D2C looks like is Tim Armstrong, founder and CEO of the DTX company. He's also the former CEO of Oath, and he's also doing a lot of great work with Mount Sinai, which I also want to talk about as well. Tim, it's great to see you this morning. To the extent that we can take away something from the report and what Ruth said in terms of how they're seeing, in terms of Google being a bellwether, if you could even think about it like that, or for the rest of the economy.
Yeah, Andrew, great to see you guys, and thanks for all the stuff you guys are doing every day. I would say this: the summary on Google from what I saw yesterday was, short-term pain, long-term gain. Google looked to me like Google had probably 2 years worth of consumer growth in 2 months. And while advertising got hit, I think, Google is generally probably the last company to get cut on someone's budget. It'll probably also be the first to come back. So if you're a longer term investor and you're not short term, I think you just had the largest education cycle of Google products, number one. And number two is you actually saw their strategy on cloud and some of the other areas that are kind of decoupled from their consumer business with really strong growth. So I walked away from, watching their earnings thinking, long term, probably very powerful freight train of revenue is going to happen over the next, 2 to 5 years. There might be some short term pain. There will be short term pain. But that was my takeaway.
Well, that's what I was going to ask you in terms of what that short-term pain is and whether investors should just look through it. We had Barry Diller on the program recently. He had said Expedia typically spends something on the order of $5 billion annually. He said they'd be lucky if they spent $1 billion this year. I imagine a lot of that money is going to the likes of a Google and a Facebook.
Yeah, it is. I'm involved with multiple companies and talked to multiple CEOs over the last month, and we've been working with about 40 different brands at DTX. So I have pretty intimate knowledge about what people are doing with their marketing budgets. And I'd say, people are cutting their budgets in very, very deep ways. But generally, Google's the last to get cut, and digital is the last to get cut. So anything where there's consumer usage growing and accountability and transparency is, really important. I'd say in the commerce world, also Google mentioned commerce on their earnings call. Yesterday, I think there's some very big trends in commerce coming out of COVID and will come out of COVID as well. So if you think about the financial crisis in 2008, 2009, it was also the launching pad for mobile. And I would say the launching pad for DTC, for direct-to-consumer commerce, is going to come out of COVID. Consumers are getting highly educated on DTC. Really the big brands, the big retailers, they don't want to rent consumers. They want to own them, which means they need to go direct to consumer. So there's a lot of, human effort and work needed done to get the economy restarted. But I think when you come back out of it on the other side, digital, especially the big digital brands, are going to get stronger. And you're going to see, e-tail and DTC are the two main components of future commerce coming out, be really strong.
Tim, so much of the direct-to-consumer world, though, is a discretionary spend at the moment. A lot of it's clothing and the like. What are you seeing in terms of the companies that you're involved in an environment where, frankly, all you have to do, I am wearing pants today. That's the good news, and I am every day. But the point is, most people aren't seeing other people. So the idea of getting dressed or buying new clothes or new fashion seems hard to imagine.
Yeah, I think like all other businesses, Andrew, the DTC companies, the ones that have the right leadership, the right really CRM relationship with their consumers and really the right balance sheets, when they get through this, they're going to be stronger. I know that from human behavior, COVID has changed a lot of human behavior, but human behavior around how people look and feel and the products and services they buy are going to come back, and they're going to come back strongly after COVID. And two is there's other things that people aren't really paying attention to, which is if you look at the digital payment apps and things that fuel DTC, those grew by 60% in March. So while you see the lowering of commerce overall and consumer spending, behind it, the really strong foundational pieces from payments to people understanding what DTC brands are to delivery to people building their CRM systems is really why we bet on DTC long term, and why at DTX we're so bullish about it. And when I look at the secondary statistics, I actually get more bullish after COVID that a lot of these brands are going to really excel. And some of the brands we have, Olive and June, I think I might have mentioned last time I was on, they do in-home mani-pedis, and they have the most successful, businesses in Los Angeles that deal to the highest tier clientele. And they've taken that now, democratized it out across the United States. They're going to be ultra successful after COVID. And those are the businesses, the DTC businesses that are built to have direct relationships with you, are only going to get stronger.